Portions of the program may be pre-recorded.
The following program is sponsored by Max Out Savings Advisors. The views expressed during the broadcast are solely for entertainment purposes and do not necessarily express the views of KNTH, its management, Max Out Savings Advisors, or its sponsors. Max Out Savings Advisors and members of the Max Out Savings team may or may not hold securities mentioned during the show. Plan for your prosperity, prepare for your retirement, safeguard your savings, and nurture your investments. This is the Max Out Savings Show with Ted Gioka, a presentation of Max Out Savings Advisors. Now, here's your host from Max Out Savings Advisors, Ted Gioka.
Welcome to the Max Out Savings Show. I'm Ted Gioka, and we're talking savings investments in your retirement here on the Max Out Savings Show, one of Houston's more popular financial radio shows. We've been on for well over a decade, actually getting close to 2 decades here, and talking about savings, talking about investments, and understanding the world today. Our motto and our philosophy is to save aggressively and invest conservatively. That's save aggressively and invest conservatively. And you always want to start out using your company plan to try to increase your savings to get where you need to be for retirement. It's called income-based savings. And what it is it is a method of saving money where you put away a percentage of your paycheck. The research says if you put away a minimum of 10% plus you get a company match of, say, 3%, that should be enough so you build up your retirement. And you're going to have a successful retirement whether you're making $30,000 a year or $300,000 a year, because you're going to typically spend up to where your income is, and this will get you there. You're going to get tax-free growth if you put money in these programs. And look, and I know most people listening are in these programs, but it's always good to remember why you're in these programs. You're getting a tax deduction right off the top. So if you put $10,000 into your program, you get a $10,000 deduction on your taxes, which reduces your adjusted gross income. Then the $10,000 grows for the next 20 or 30 years till you need it at retirement, completely tax-free. That's the best deal out there. As I've said often on this show, is Warren Buffett. If you study Warren Buffett, one of the things that he did more than anything else was he would come in and he would figure out ways to minimize his taxes. And whatever it took, he bought an insurance company. That's how he got in the insurance business, because he realized that he could have more tax-free growth in an insurance company if his investments were an insurance company. He'll do anything he can. If a company is taken over, he will go and he will purchase he will take stock in the new company, because if you take stock, you don't pay taxes. You just roll it into the new company. And this is something to remember. If you're ever, if one of your companies, your investments are taken over, you have a choice of cash or you have stock. Well, if you take the stock, you're going to you just collect you get the new stock. It's just a transfer of ownership. And what you got is, and what you have is a non-taxable event. If you take cash, then it's going to be taxable. So this is something that you want to understand. This is something you want to work on. Always minimize your taxes and investments. That's one of the key things in the investing world. One of the other things is you get that income tax break, so you're getting part of your money back. Plus, in addition, you got a company match, which was very good as well. And so those are some of the things that you need to do. And tell you what, our producer, can you check? I'm getting feedback on my end when I'm talking. Could you check the board there? But what we're dealing with is you want to be able to put away the money. You want it to get you a tax deduction. You want to get the company match, And then you also would like to get the tax-free growth. That's the key to building up wealth over the long term. Now, we got a lot to talk about here on the show today. As always, it seems like. We had the Jackson Hole meeting this week. We still have some. We're trying to get peace in the Russia-Ukraine war. We've got markets, sky high markets. We've got a bubble in the tech sector, AI sector. We're going to be talking about all of these things in here today. And a couple. I want to start with the Jackson Hole meeting. This is a big Federal Reserve central bank meeting, and this is a little in the weeds, but stick with me. It's important to understand it. And what it is they sit and they meet and they go over, in the rest of the central bank, they pull all the central bankers, the Federal Reserve Bank presidents from around the country. Then typically you get the central bankers from many other areas of the world come in. They all meet and go over the situation. And this time there was a lot of anticipation of what Chairman Powell was going to say. Well, he said a couple things, and I read through the report a couple times in his talk. But really what came out of it more than anything is inflation is higher than they would like, but the unemployment is a little weaker. And the jobs market is somewhat balanced, but it seems to be weakening, and that's sort of the concern out there. And one of the key things he said is the tariff effects appear to be short term, which was the big reason that the Federal Reserve hasn't cut rates, was because they weren't sure if all the tariffs that President Trump put in were going to cause inflation. And President Trump, and why this meeting was so important, is President Trump had been pressuring Chairman Powell of the Federal Reserve to cut the short-term rates. So longtime listeners of the show know that with short-term rates, the Fed can control short-term rates, but they can't control long-term rates. It's more difficult. And so President Trump he's come in office. He's been in office, 7 months or so, and he's dealing with a $35 trillion deficit, $37 trillion deficit. They're borrowing money again at the rate of about $1 trillion additional funds every 120 days. So about 60% of the federal budget is going of the debt of the $37 trillion worth of debt is going to be refinanced in the next 3 years. So if he can get Chairman Powell to cut the short-term rates, which are about 4.415, something like that right now, if he can get them to drop them, then on the short end, then that's going to help cut the deficit. And it's because it's going to cut the interest rate. Keep in mind, our interest rates are around $1 trillion. Every year we're paying an interest on this ridiculous federal debt. Joe Biden ran the debt up about 24% when he was president. And so it's a difficult situation. So he's pressuring Chairman Powell to cut the interest rates, and Chairman Powell and the Fed is like, look, we're an independent agency, things are fine. You can't tell us what to do, and the power of the dollar is because we have an independent Fed. There was this sort of a standoff. To some extent, Chairman Powell blinked and said that, look, the tariffs look like it's a one-time thing, and so the markets went up across the board. With the Dow Jones going up about 900 points, so it was a very good day, for stocks. It was a good day for a number of things out there. The Dow ultimately went up 846 points, which is a huge move. It was up almost 1.9%. The S&P was up nearly 100 points, up 1.5%. It was pretty much across the board. Gold went up 1%. Silver went up 1.9%. The dollar fell 0.9%. People, holders of the dollar weren't real happy about that. And because short-term rate, the long-term rates fell about 1.6% to 4.2. So to summarize, stocks, gold, oil, crypto, silver, everything went up. The dollar fell. And people, I think, are viewing this as more inflationary. And so we'll kind of have to wait and see on this. One of the more disturbing things about the whole deal is that, keep in mind, this is the big Federal Reserve meeting. The head of the Japanese central bank, the European central bank, the UK central bank, they were all there. Central bankers from all over the world were there. And they're concerned about inflation. There was not one word mentioned about the $37 trillion worth of debt. There was not one word mentioned by the Federal Reserve on the $2 trillion deficit we're running. And the Federal Reserve has not said one word the whole time that Joe Biden was recklessly running through $2 trillion deficits for the 4 years he was in power. He ran the debt up an enormous amount. His deficit spending was averaged about 6.5% of GDP every single year. I think 1 year it was a little lower. The rest of the time it was higher. Across the board, recklessly spending money, throwing money out there for DEI, throwing money out for Green New Deals. Just anybody that had the most lunatic project, they gave them money. It was the most reckless spending probably since Caligula was running Rome. And Federal Reserve didn't say a word. The Federal Reserve didn't say a word about it today. They don't seem to. They as near as I can see, the Federal Reserve's job is to ensure we have full employment and no inflation, and the government can spend as much money as they want. They can recklessly run up deficits, and the Federal Reserve has nothing to do and nothing to say with that, which is utterly ridiculous. And this is why gold went up. This is why other things went up, because again, we're dealing with the Federal Reserve that has pretty much lost their way. They sort of became. No one wanted to say anything under Biden's term in particular, because they were building out the new Green Deal. Remember, we were going to net zero with carbon, with CO2, and this was going to take a huge build out, which was going to run up massive deficits. But nobody said anything, because if we didn't get rid of all the CO2, we were all going to die. Remember the Davos crowd in the World Economic Forum? Those people were just Larry Fink, the new head of the World Economic Forum, the modern day Communist Party for all practical purposes, and I mean that seriously. It's instead of the communists, running the country for the people, the World Economic Forum wants to run the whole world for this elite group of people that are going to rule the world and tell everybody else what to do. I mean, in that environment, most people are going to choose communism, and it's something people. But I'm digressing here. But what we're really dealing with is a Federal Reserve that has been asleep at the wheel. I remember the time when Paul Volcker, head of the Federal Reserve, would go up to Congress and talk, and those congressmen would be afraid to ask the guy a question, because he would just blast him about government spending or deficits or something else that they didn't want to hear about. And somehow we've managed to morph this Federal Reserve into basically just a special operation to ensure that stocks never go down and Wall Street's taken care of. I think this still opens up the door for inflation. I think the Powell's under a lot of pressure, so they're likely going to cut the rates and see what happens. But what we think are going to happen is we think inflation's going to continue. We think we're going to see a growing economy, but going into the fall, we're going to continue to see a slowdown in the economy, and I'm going to tell you why. It's a real interesting idea that you're probably not hearing anything about. And actually, Chairman Greenspan covered it sort of tangentially, and everybody missed what he said. We're going to talk about that right after this quick break right here on the Max Out Savings Show.
The Max Out Savings Show with Ted Gioka is taking your calls now at 713-339-1070. Ted Gioka will return after these messages.
This is Ted Gioka, host of the Max Out Savings Show, one of Houston's most popular financial radio shows, celebrating over a decade on the air in Houston, Texas. With stocks at record high valuations and interest rates near record lows, you need to have your guard up. You need to have a plan to manage risk to your retirement. Do you? At Max Out Savings Advisors, we have a risk-based value investing approach to your retirement. If you would like some help managing your retirement, go to maxoutsavings.com to set up an appointment. That's maxoutsavings.com.
Hey everybody, Charlie Kirk here. Ted Gioka, the founder of Max Out Savings Advisors, always says, save aggressively and invest conservatively. He specializes in helping people grow their retirement account with as little risks as possible. Ted combines working knowledge with the intuition gained from over 25 years of experience of value investing in the stock and bond markets for retirement accounts. Like you, Ted is deeply conservative in life and in his investment approach. His risk strategy allows him to anticipate market downswings to protect your money. Ted is also the conservative host of the Max Out Savings Show. You can listen to him every Saturday morning at 10 a.m. right here on The Answer. If the idea of saving aggressively and investing conservatively appeals to you, the best way to get to know Ted is to call him. The number is 713-627-0400 or visit maxoutsavings.com. That is maxoutsavings.com. Call Ted right now, 713-627-0400 or visit maxoutsavings.com.
Hi, I'm Sam Malone, the owner of Houston's cutting-edge media company called 512 New Media. At 512 New Media, we create amazing videos that companies use on their websites, telling their story in bold colors with exciting animation and graphics. At 512 New Media, we also shoot television commercials and instructional videos. And if you want to show off your business from the air, we're ready to go with our drone video aircraft. Let us help you create your media message. We're online at 512newmedia.com or call 281-822-8803. 512 New Media is Houston's only media creation and distribution company that's actually owned by someone who's currently on the air. And that gives us an incredible edge when creating content for consumers to use on their laptops, tablets, and smartphones. Standing by to create your message, we're 512 New Media, 512newmedia.com.
Hi, this is Ted Gioka of the Max Out Savings Show. Our motto and philosophy is to save aggressively and invest conservatively. The world is changing at a faster rate than any time in the last 50 years. The investment world has changed. Have you changed? Inflation will destroy your retirement. It is a different world that requires different strategies and ideas. The era of indexing and investing is over. If you need help, listen to the Max Out Savings Show. Our show airs every Saturday at 10 a.m. and Sunday at 7 a.m. We talk about investments, the world, and where the world is going today, and help you understand it and help you save money and build up wealth. It's the Max Out Savings Show. And if you need some help, go to our website, maxoutsavings.com. That's maxoutsavings.com. On the website, you can sign up for the free Max Out Savings Report. Our report covers all types of these big issues, the changes in the world, and helps you understand and protect your retirement. So go to the website, maxoutsavings.com. In the 1970s, the big song was the Bee Gees' Staying Alive. Well, it was difficult back then to stay alive if you were a retiree. Inflation was running rampant, and since then, over the last 25 years, it's gone away. Well, inflation's coming back, and it's going to endanger your retirement. If you're a retiree, inflation is your biggest enemy. Hi, this is Ted Gioka of the Max Out Savings Show. If you need help with your retirement, I'd like to help you out. Go to maxoutsavings.com. That's maxoutsavings.com, and we'll show you how you manage through inflation. Don't let inflation destroy your retirement.
If you can snap your fingers, you can find this radio station. So the next time you want to listen to us, your smartphone is now your smart radio. We're always on. This is AM 1070, The Answer.
We return now to the Max Out Savings Show. Here's Ted Gioka.
Welcome back to the Max Out Savings Show. We just had a little issue with the phone. We took care of that. So we're talking about some of the issues that's happening. And during the talk in Jackson Hole, Chairman Powell kind of skipped over the remark about the labor market and immigration, and what they're doing. They're having trouble because jobs are going down, but joblessness isn't really going. The unemployment rate wasn't really going up because the number of people looking is dropping. And what we think is happening is there's less illegal immigrants looking for jobs. President Trump, we've had an illegal immigrant problem. We've got probably 20 million illegal immigrants in the United States. A lot of them are working. And now the government and ICE are going out catching the illegal immigrants. And so people that aren't here legally are being very cautious. Some of them aren't working anymore. They're staying home. They're not going out to eat. They're not buying a car. Are you going to buy a home if you're worried that you might get picked up by ICE and deported, next week? And the answer is no. And keep in mind, there's probably been 4 or 5 million illegal immigrants pour in when Joe Biden opened the borders and basically declared the country without borders. But there's another probably 15 million people that have been here, some of them for 20, 25 years. And, when they were children and stuff. And so those people are much more cautious. We believe this is starting to slow down the economy some. We saw the statistics, some of the restaurants, it's slower down. Modella sales were down 6%. Again, this is kind of people pulling back. If you're talking about 15 to 20 million illegal immigrants, and remember there's like over 40 million people on different types of visas in this country as well, where they're going to start reviewing the visas. And again, this is going to slow down people. So many of these people are working, they're working legitimately, but they're still, some of them are here on student visas. They should have gone back a couple years ago. But so we believe this is slowing down the market, the economy, and so it's not being talked about. You're not hearing anything about it because no one really wants to talk about it. But it's going to be there. I think it's going to come into the fall. On the flip side of that, President Trump is getting huge numbers of factories sent back to the United States. Very few of them seem to be coming to Houston because we don't have reliable electricity in this city, which is truly astonishing. After living here most of my life, it seemed to work just fine until recently, but that's another story. But what we're dealing with here is a I've lost track here of my thought, but is the slowing down. So the factories are coming back here, but there's a slowdown now. I think that's what we're seeing. The question is inflation going away? We don't think so. If you look at, the precious metals had a big day. Silver broke out to higher levels on Friday as well, closing over $38, close to $39. Again, cryptos, one of the cryptos, I think Ethereum went up like 13%. I mean, people are like, look, just get me into something beside the dollar. There's just concern about the spending levels in the United States. And again, we just had the Jackson Hole meeting, and everything was all set. They talked about all these issues, but they didn't talk about the elephant in the room is the federal spending and the deficit spending. Under Joe Biden, 6.5% of GDP. It's probably even under Trump, he's trying to cut it everywhere he can. It's probably going to be in the high 5% of GDP, which is just, these are almost wartime levels of spending. This is the type of spending, a 6% GDP deficit spending, which means you're spending 6.5% more than you're taking in. This is the type of stuff that you. Just a second. This is the type of stuff that you get when you're at wartime. This is not the type of things when it's a pretty good economy with low unemployment. This is when you're at wartime, you're in a big recession. Unemployment is 6.5%, 7%. You've got to spend money to keep people, to create jobs, to try to help people out. You got to spend more money on welfare. You don't have any choice. But you don't go spend that type of money when business is good, unemployment is low, the economy is growing. But you do if you have a Green New Deal that if you don't get rid of CO2, sometime in the next, decade and a half, all life on planet Earth is going to cease, and which the most amazing thing about that is that went along real well up until AI came out, and all of a sudden Larry Fink at BlackRock went from he was going to defund oil and gas to starting investing in oil and gas to help out AI, and it's just but this is the world we live in. It's unstable in many areas. It's moving around, and I think you have to be cognizant. And as we talked about on the show, to protect your retirement, you have to have things that are going to grow in inflation. You have to have things that are going to keep up with inflation. And we said that the 60% stock in the S&P 500, which has worked real well, and 40% in long-term bonds, hasn't worked well. About 3 years back, we had the market down about 18% or so, and the long-term bonds had the worst bond returns, some say, in 100 years. And it's again, out of control spending. You have the S&P 500. The top 10 stocks in the S&P 500 account for 40% of the averages. Now they're basically all technology stocks, but what happened is the S&P Corporation, they realized that this was a ridiculous overweighting and you couldn't justify it. 40% technology, so they moved they moved Amazon over to consumer products or something. They moved some of the other ones over. Google, I think, is in the same thing, or some type of consumer, and they kind of shifted some of them around into a couple different areas. Microsoft's technology, NVIDIA's technology, Apple's technology. Google, I think, is consumer. I think Tesla is automotive. So so they moved some of them out of those areas, but it still comes down to the same issues. The S&P 500 is massively overweighted to technology. Now, here's the interesting thing: a lot of it is in AI, which there's an enormous amount of money pouring into AI. Meta just is building a massive AI facility in upstate Louisiana. It's going to be like $50 billion. They're putting together a group with, I think, PIMCO and some other people, like Blackstone or whoever, to sit there and fund it. But the problem they're running into is their demands for capital are so high that they're starting to run out of cash at Meta. If they continue this, they're going to run. So they're having to sit there and get other people to fund this stuff. There's going to be probably $1 to $2 trillion worth of spending on this. And the question is, where's the money going to come from for AI? And there's starting to be some concern on this. This week, Sam Altman, who runs one of the big companies, the not ChatGPT per se, but I think it's the company that's backing them. But he said investors are overly excited about the technology. In some of the cost, it's going to cost a phenomenal amount of money to build this out, and some of that won't get good returns, effective is what he said. MIT did a study, and they found that 95% of the AI organizations are getting zero return. 150 interviewed 150 business leaders, 350 employees, and they looked at it. About 80% of the people have looked at it. About 40% have deployed on it, and about half of the AI projects they've tried have failed. And what they're finding is a lot of these employees, they got these AI programs or these deals that are rolling out at the company. Well, the employees are using ChatGPT or Grok because it's easier to use than what they've got. And again, these are enormous amounts of money. Here's another statistic with AI. Right now, there's 400. Okay, there's how many companies in the S&P 500? 500, right? Well, there's 498 AI companies with market caps called, we call them unicorns. They're private, with market caps in excess of $1 billion. 498 of these companies out there. Total market cap is about $2.3 trillion. And it just shows you how much money is pouring into the sector from all over the place. This is why the scramble for the AI chips and everything else under the sun. And the question is, what is the valuation? We have some of these companies. I think Palantir had a sell-off this week. It's now down. It's a good value because it went down. The PE is only 240 times earnings. And again, you're talking about massive valuations, enormous amounts of money spent. People still aren't sure how it's all going to pay out. And the demand for energy is so high that it flipped the whole script on this net zero energy and induced a massive scramble to produce power across the globe. And so I think the question is, where does this end? And AI is going to be around. AI is going to be successful. But what it's like the automobile, it's like the internet, it's like everything. There's going to be winners and there's going to be losers. And the question is everyone's a winner right now, and that's very, very unlikely. And so I think there's a real issue, and I think there's, for the first time this week, we're really seeing some real pushback on the valuations on the internet stocks, on the valuations of the private companies, on the question of, hey, how much of this is really going to be profitable? We're seeing even massive companies with billions and billions of cash and virtually no debt are really struggling to fund the stuff. And I think this is the thing that's going to be coming. I mean, something we talked about is how are these companies, how are they able to spend? I think I want to say Facebook spending, I think $70 billion next year, and yet their earnings are going to go up. And you're like, wait a minute, how are you? I think they spent like $30 billion, something along 30 or 40 billion this year is going to $70 billion next year, and earnings are going to go up another 20%. And you're like, wait a minute, how are you spending all this money and it's not affecting your earnings? And the answer is they're running the depreciation schedules much further out than they should be to try to stabilize their situation. And eventually people are going to start looking at the quality of the earnings and what type of bookkeeping is being used on these big companies. So I would continue to be cautious on this. If you look at the Mag 7, I think they're up like 10 or 11% year to date. They're not up that much. Precious metals have way outperformed them. Crypto's way outperformed them. Gold and silver stocks have way outperformed them. But everybody just keeps talking about it because there's such a frenzy in the sectors. So I think you need to be careful. I think you need to understand the risk in the sector. And as we've talked about on this show, it's really going to be more important than ever to spread out that risk because we're in a situation, but there's been so much money poured into the system under Joe Biden. The Federal Reserve has just been flooding the system with money. That huge numbers of people are spending it all over the place. They're taking on debt. And the question is, look, where's all this money going to come from? Where's the money going to come from to fund out this trillions of dollars of borrowing the United States has to do? Where's the money going to come? The debt borrowing is going up in China. Borrow is going up in Japan. Borrow is going up in Europe. If you look at the 30-year bond in Japan, it's over 3%. It's hitting a new high that goes back about 25 years. The Japanese are one way we've really been funding huge amounts of our deficits and the stock markets as well, because the Japanese, the yen hasn't gone anywhere. Interest rates were close to zero. Now they're longer term, they're at 3%, and the money is starting to come back. Again, there's huge demand. Where's all the money what about corporate America? We're spending trillions of dollars on AI. Where's all this money going to come from? And there's going to be a crowding out eventually, and that's going to push up cost across the board. And so this is, again, what we're looking at is an expensive market that's going to start coming into funding issues. And I tell you what, we're going to be talking some more about that right after this quick break right here on the Max Out Savings Show.
If you've got savings and investment questions, Ted Gioka has answers. Call the Max Out Savings Show now at 713-339-1070. We'll be right back.
This is Ted Gioka, host of the Max Out Savings Show, one of Houston's most popular financial radio shows, celebrating over a decade on the air in Houston, Texas. With stocks at record high valuations and interest rates near record lows, you need to have your guard up. You need to have a plan to manage risk to your retirement. Do you? At Max Out Savings Advisors, we have a risk-based value investing approach to your retirement. If you would like some help managing your retirement, go to maxoutsavings.com to set up an appointment. That's maxoutsavings.com.
Hey everybody, Charlie Kirk here. Ted Gioka, the founder of Max Out Savings Advisors, always says, save aggressively and invest conservatively. He specializes in helping people grow their retirement account with as little risks as possible. Ted combines working knowledge with the intuition gained from over 25 years of experience of value investing in the stock and bond markets for retirement accounts. Like you, Ted is deeply conservative in life and in his investment approach. His risk strategy allows him to anticipate market downswings to protect your money. Ted is also the conservative host of the Max Out Savings Show. You can listen to him every Saturday morning at 10 a.m. right here on The Answer. If the idea of saving aggressively and investing conservatively appeals to you, the best way to get to know Ted is to call him. The number is 713-627-0400 or visit maxoutsavings.com. That is maxoutsavings.com. Call Ted right now, 713-627-0400 or visit maxoutsavings.com.
Hi, I'm Sam Malone, the owner of Houston's cutting-edge media company called 512 New Media. At 512 New Media, we create amazing videos that companies use on their websites, telling their story in bold colors with exciting animation and graphics. At 512 New Media, we also shoot television commercials and instructional videos. And if you want to show off your business from the air, we're ready to go with our drone video aircraft. Let us help you create your media message. We're online at 512newmedia.com or call 281-822-8803. 512 New Media is Houston's only media creation and distribution company that's actually owned by someone who's currently on the air. And that gives us an incredible edge when creating content for consumers to use on their laptops, tablets, and smartphones. Standing by to create your message, we're 512 New Media, 512newmedia.com.
In the 1970s, the big song was the Bee Gees' Staying Alive. Well, it was difficult back then to stay alive if you were a retiree. Inflation was running rampant, and since then, over the last 25 years, it's gone away. Well, inflation's coming back, and it's going to endanger your retirement. If you're a retiree, inflation is your biggest enemy. Hi, this is Ted Gioka of the Max Out Savings Show. If you need help with your retirement, I'd like to help you out. Go to maxoutsavings.com. That's maxoutsavings.com, and we'll show you how you manage through inflation. Don't let inflation destroy your retirement.
And now, more of the Max Out Savings Show with Ted Gioka.
Welcome back to the Max Out Savings Show. We just want to mention one of our sponsors, Rangoni Alto Gin. It's a fine botanical gin produced in the Italian Alps. And, you know, I've tried it myself. It's phenomenal. Everyone I've talked to that just loves this. This is just an incredible gin that they put together using the finest organic botanicals, glacier water, and just, literally hundreds of years of experience, or probably close to 1,000. We've really looked into it, of experience to put together just an incredible drink. It's called Rangoni Alto Gin. You can get it at Specs or Total Wine. Look for the kingfisher bird on the label. Now, I want to get back to this MIT report on AI, really kind of pointing out that there's huge amounts of money being poured into AI, but remarkably small amount being successfully implemented embedded for specific tasks. It basically 5%. If it's a general purpose large model, they have about a 40% success rate. That's like a Chat GPT or a Grok. Those things kind of work, but it's specific type of thing. They're only 5% successful. Well, since this has come out, that, as we talked about on it, the Sam Altman who's OpenAI, he basically, they asked him about it, and he said, are investors overexcited? My opinion is yes. And the actual quote was, some people stood to lose a phenomenal amount of money. And since the report came out a couple of days ago, its SoftBank price fell nearly 10%. And so I think this is just, and the other thing that's happened is Meta has announced that they're no longer hiring any more AI scientists or engineers because they've been, in some cases, offering people rumored to be $100 million or more just at these engineers just to come over. And so they've announced. So clearly something's up out there. This is why you saw the sell-off this week. Now, Chairman Powell came out. The markets were all resting really at support lines from all types of technical indicators. There was a lot of people short in the meeting, ahead of the meeting. And then Chairman Powell basically said, look, tariffs probably looks to be inflation is short-term issue, and the stock market shot up, and there was a huge amount. This was just a short covering rally. Again, you can kind of see what's working is because the alternatives. People are going, they're going to cut rates. They're probably going to, no telling what they're going to do. They're going to do whatever Trump says, which means the dollar went lower, gold and silver went up, crypto went up, those type of things. Assets, hard assets went up because remember, you can't create any more gold or silver. Well, you can, but it's not. We talked on this show about, if you look at it for the last 5 years, there's been a deficit of silver. They're using much more silver than they're producing. I think for the last 4 years, it's about 678 million ounces of silver more than they produce. Gold just kind of stays above ground, but the marginal difference for production is virtually zero. And so they're really not producing more of these things, right? The whole secret to crypto is you can't really print any more crypto. I mean, the problem people have is the Federal Reserve is printing money, and everybody knows it, and it looks like they might start up again. So I continue to like the sector. I continue to think that you want to really sit down and look at diversifying in different asset classes. If the other thing that we're writing about in our Max Out Savings report is to discuss this issue is the valuations in the market have just gotten to be incredible. As we talked about, the top 10 stocks equal almost 40% of the index. And during the tech bubble, during the 1999 internet bubble, that number was 25%. It's almost 40 now, and this is a concern. If you look at the valuations, if you look at the PE ratios, if you look at the CAPE ratios, price to sales, the average percent, it's at record high. One chart I'm looking at is stock valuations. Look at the trailing PEs, everything else, in the market cap to GDP. It's at a level that it was during 1929, 1965, and 1999. And all of those were all bad years. I mean, I think he even mentioned on the last show or something, this market kind of looks a little one before. It almost looks like a 66 type of market with the Nifty 50 at the time. But the valuations are just so over the top now. It's just incredible. And I think people have to be cognizant of that. And the reason that's important is if you look at the numbers of what your expected valuations for long term is, if you adjust that, you're really looking like the market's going to go nowhere for years. One of the things about a cheap market is if you go and run the cheap, when the market's at 13, 14 times earnings, if you look at the valuations 10 years in the future, they tend to be a lot higher. Whereas if you look at markets when they're at 23, 24 times or more, they tend to be lower or the same 10 years in the future. And if you're running a retirement account and you're counting on 6, 7%, 8% a year or more, on your retirement and you're taking that out and you get a decade where you're not getting any return, or if you look at Japan where they had the 30 years of the market kind of going down, you're in trouble. And in the 70s, it was like that. The market did nothing during the 70s. I want to say from 1966 to maybe 1981, 82, the market, I don't think it topped 1,050, maybe 1,057, something like that. And it just really, it just didn't do anything. Now, some of the people I started out years ago actually made a fortune in the 70s. Yeah, they were some of the best people. They were stock pickers. But there's ways to make money in that environment. But if you're in that index, it doesn't go anywhere. I mean, the S&P 500 is what the Dow Jones Industrial Average was 50 years ago. It was 70. Yeah, 50 years ago. And so this is the danger when you have these high P's. Now, can the market keep going up from here? Yes. But understand, in retirement, this is a long-term game. If you retire at the age 65, you got a really good 50% chance you or your wife lives to be 91, 92. So you're looking at 25 years or more of having to survive off that money for retirement. And it is so important to protect it and diversify out in these and have people that can understand how to deal with markets like this, understand how to diversify and try to avoid big issues and problems. And I think, as I said on the market last week, I looked at a couple stocks we were reviewing. We had earnings calls coming in, and either you listen to the earnings calls or you catch the transcripts at different places, and it's much easier than it was 20 years ago. Really, you can pull the transcripts off the internet now real quickly, and 20 years ago, sometimes you're not even sure you were going to actually get invited to the calls. And so it's much. So we went through the stocks, and I was surprised. We actually had 4 stocks under 9 times earnings, and I felt 3 of them. I felt really strongly, hey, 2 years from now, where's this company going to be earnings wise? And we felt very strongly it was going to be higher, much higher, and it was at 9 times earnings. So there is value. There are things in the market, but what I want you to understand is you have to have a much more diversified portfolio. For the first time in years, foreign stocks are outperforming U.S. stocks, and so this is the key, of what's going to happen. But we live in a very, very a world where there's a huge amount of debt, where there's a huge amount of problems, and so you're going to get movements in these markets. A world with $37 trillion of debt in the U.S. government borrowing $1 trillion every 120 days, with the Russians and the Ukrainians at war, with the Europeans borrowing even more money than we are, and with the Chinese in trouble and their real estate market collapsing, and real estate is the biggest asset for the Chinese. All of these things add up to real issues. Where in a world where the U.S. is scrambling to bring manufacturing back to the United States. Look, I mean, if I really sit down and studied, I think the United States think there's going to be a war with China, and I think they're moving heavy in earth to get their manufacturing capacity back to the United States in case something goes wrong. Does that mean we're going to declare war? No, but it does mean that, oh my gosh, if we go to war, we don't have the manufacturing capacity. We don't have the factories. We don't have the commodities. We don't have the rare earth minerals. We don't have the copper. We don't have the things we need to fight the war because we've farmed, big corporations in America farm so much of this stuff overseas. And we had the first lesson with the pandemic where 85% of the precursors for chemicals for most of our antibiotics and everything else were coming out of China. And the Chinese like, hey, we're shut down. And we're like, oh, no. So these are big changes rolling around the world and stuff. In that environment, that's not the environment where bull markets go up forever. And we have a very expensive one. So I think you do have to be cautious, understanding, what's happening in the world today and how to deal with it. And so this something to think about. What else do I want to cover? I talked to some people about their inherited IRAs the other day, one of our clients. And one of the things, if you inherit an IRA, they've changed the rules up. So once past 2020, you have to take all of it out within 10 years. And so this is a big deal, particularly if you happen to inherit a bigger IRA, which sounds pretty easy. Hey, what's the matter with that? I get to take out if I've inherited a $500,000 IRA, and which isn't huge, but it's if after 10, that means I get $50,000 a year. This is great. Well, not exactly, because what you got is you have to pay taxes on that $50,000 at your top marginal rate. So it requires additional tax planning. So if you need some help there, go to our website, and a couple things. You can sign up for our free Max Out Savings report, where we write a lot about this stuff. It's called maxoutsavings.com, and I've got the report where it's going to be going out here over the weekend. And talks about everything from the issues with the markets to what we're seeing with AI to how to handle your beneficiary. All these things are in the reports over time. We come up with phenomenal stuff. In 2007, we said there was going to be a collapse of the investment banks, and unlike most people, we explained who was likely it was going to be and exactly why, and we were right. So if you need some help, go to the website. If you need help with your retirement, we can help you manage it. We hold the assets at Charles Schwab. They're our custodian, and Max Out Savings Advisors manage it using our value investing approach. Anyway, I hope everyone has a great weekend. And remember our motto in philosophy, which is to save aggressively and invest conservatively. Save aggressively, invest conservatively. That's the key to building up wealth over the long term. In real uncertain times, if you manage your assets correctly, you can ride through anything, and that's one of the real key things. So take charge of your retirement, save for your future, build up wealth, save aggressively, invest conservatively. Go to the maxoutsavings.com, sign up for the free report, and I hope everyone has a great weekend. And we'll see you next week right here on the Max Out Savings Show.
This has been the Max Out Savings Show with Ted Gioka, a presentation of Max Out Savings Advisors. Join us next Saturday at 10 a.m. for the Max Out Savings Show with Ted Gioka on AM 1070. The Answer.
If you can snap your fingers, you can find this radio station. So the next time you want to listen to us, your smartphone is now your smart radio. We're always on. This is AM 1070, The Answer.